A new law has just been passed that could quietly reshape your entire pension. It's called the Pension Schemes Act, and it became law this April. On the surface, it sounds like something only politicians and pension companies need to worry about. But buried inside it is a rule that could decide whether your pension grows, shrinks, or stays exactly where it is. By 2030, every large pension scheme in the UK must hold at least £25 billion in assets. If your scheme is too small, it will be forced to merge into a bigger one. The government says this will make pensions more efficient. But new research tells a very different story. Stick with me, because what I'm about to show you could change how you think about your pension forever. Before we go further, let's be clear about why this matters right now, in 2026. This isn't a proposal, and it isn't a rumor, it is now the law of the land. It covers roughly £2 trillion of pension savings, which is close to the size of the entire UK economy. Over 20 million working people could feel the effects of this new rule, whether they realize it or not. Later in this video, I'll explain exactly how to check if your own pension scheme is at risk of being merged. I'll also show you what a forced merger could mean for your fees, your investments, and your retirement date. And I'll reveal a part of this law that lets some pension money be handed back to employers, not savers. Let's start with the simplest question, which is what this new £25 billion rule is really about. Under the old system, there were hundreds of separate workplace pension schemes, all competing for your savings. Some of those schemes hold just a few £100 million, which sounds like a lot, but is actually considered small. The government now says a scheme needs at least £25 billion to be efficient enough to keep operating. If a scheme cannot show it will reach that size by 2030, it will lose the right to accept new workplace contributions. Once that happens, that scheme is expected to merge with a larger one, creating what the government calls a megafund. Officials claim these megafunds will cut costs and boost returns because bigger schemes can negotiate cheaper deals. But here's what most people don't know. Size alone does not guarantee that your pension will perform better. There is a transition option for medium-sized schemes, and it works a little differently than you might expect. A scheme holding at least £10 billion can be allowed to continue, as long as it proves it has a credible plan. That plan must show the scheme will reach the full £25 billion target by the year 2035. If regulators are not convinced by that plan, the scheme can still be pushed into a merger years earlier than 2030. This means your pension provider could be quietly negotiating a merger with a rival company right now, without telling you. There's also a special route for brand new pension providers who don't yet have any members at all. These new entrants can apply for approval if they can prove they have strong potential to reach scale quickly. This is designed to let innovative new pension products enter the market even before they hit the £25 billion mark. But for the vast majority of existing savers, the real story is about older, smaller schemes being pushed toward consolidation. The pensions regulator and the Financial Conduct Authority will jointly oversee this process, deciding which schemes qualify for extra time. Applications for these transition pathways are expected to open before regulators finalize every detail of how the assessment will work. That means some schemes may already be preparing paperwork behind the scenes, long before any public announcement reaches your inbox. Imagine someone named John, who has worked at the same medium-sized manufacturing firm for 18 years. John has never once checked which pension scheme his employer uses, because his monthly statement always looked fine. John's scheme currently holds around £8 billion, which puts it well below the £25 billion target. Under this new law, John's scheme will likely be merged into a much larger provider within the next few years. John has no say in which provider his pension moves to, because trustees make that decision on his behalf. His new scheme could have different investment choices, different fees, and a different online portal than the one he is used to. For John, and for millions like him, this change will happen quietly, buried in paperwork he may never fully read. There's another issue almost nobody talks about, and it involves your small, forgotten pension pots. If you have changed jobs several times, you may have several small pension pots scattered across different providers. Under the new law, any pot worth £1,000 or less, with no contributions for over a year, can be swept up. These small pots will be automatically moved into an approved consolidator scheme, unless you actively choose to opt out. The idea is to stop people losing track of small pensions, which currently costs savers money in unnecessary admin fees. But if you don't check your paperwork, your old pension pot could move to a new provider without you noticing. This part of the law is not expected to fully start until schemes have reached scale, likely from 2030 onwards. Still, it is worth checking now exactly how many pension pots you have, and which ones might qualify. The consolidator schemes themselves must be certified by regulators as delivering genuinely good value before they can accept swept-up pots. This certification process is still being designed, and full implementation of small pots consolidation is not expected until around 2030. That timeline is deliberately linked to the rollout of the larger megafunds, so both changes happen roughly side by side. In the meantime, providers are already being encouraged to identify which of their customers hold these small, dormant pension pots. If you switch jobs often, or you've worked freelance in the past, you are statistically more likely to be affected by this rule. Now let's talk about something the government calls value for money, because this directly affects how your scheme is judged. Every large pension scheme will soon have to publicly report on its investment performance, its costs, and its service quality. If a scheme is rated as not delivering good value, it must take action, which can include closing itself to new savers. Schemes rated poorly may be forced to move their members into a better performing scheme, whether members ask for this or not. This sounds helpful on paper, because poor performing schemes should improve or lose customers. But here's what most people don't know. The first full reports on scheme performance are not expected until around 2028. That means for the next 2 years, you are relying on your scheme's own word that it offers good value. There is a way to check this yourself, and I'll show you exactly how later in this video. Before we get to the most controversial part of this law, there's one more type of merger you should know about. The Act creates an official legal framework for something called a superfund, which is a new type of pension provider. A superfund can take over the liabilities of a struggling defined benefit scheme, backed by a large capital safety cushion. This gives employers a way to fully exit their pension responsibilities by transferring everything to a professionally run superfund instead. Superfunds must be formally authorized by the pensions regulator and must prove they can meet strict financial safety thresholds. For members, this can mean your pension promise moves away from your original employer toward a company you've never heard of. Now here is the part of this law that has caused the most controversy among pension experts and campaigners. Defined benefit schemes, the older style of pension that guarantees a fixed income, are sitting on huge amounts of surplus cash. Estimates suggest around £160 billion in surplus is currently locked inside these older pension schemes. Under the new law, trustees will find it much easier to release this surplus money back to the employer. Supporters say this could help struggling businesses invest, grow, and even boost pay for current staff members. Critics argue this surplus technically belongs to pension savers, and releasing it to employers reduces the safety cushion protecting your pension. Imagine someone named Margaret, who worked for a large retailer for over 25 years before retiring. Margaret's old defined benefit scheme has built up a healthy surplus, well above what it needs to pay her guaranteed pension. Under the new rules, her former employer could apply to release a portion of that surplus for company use. Margaret's guaranteed pension payments should legally stay protected, but the safety buffer around her pension may shrink significantly. If her employer later runs into serious financial trouble, that smaller buffer could matter far more than most people realize. Trustees are still required by law to act in the interests of scheme members before agreeing to release any surplus at all. However, campaigners point out that removing an older legal test makes it easier for trustees to approve these payments going forward. The pensions regulator is expected to publish detailed guidance on surplus releases in late 2026, so the exact rules are still forming. If you have an old defined benefit pension from a previous employer, it may be worth requesting an updated funding statement. There's another issue almost nobody talks about, and it concerns where your pension money is actually invested. The government has given itself a new power to require certain schemes to invest a portion of their funds domestically. This is sometimes called the Mansion House Accord, and it could direct pension money toward UK businesses and infrastructure projects. Supporters say this could boost economic growth, create jobs, and give savers exposure to fast-growing British companies. Critics worry that political priorities could start influencing investment decisions rather than pure financial performance for savers. Importantly, this specific power cannot be used before January 2028, giving schemes some time to prepare. Still, it is worth watching closely because it could quietly reshape where a portion of your future pension growth comes from. Let's bring this back to you and what you can actually do about all of this information. First, find out the name of your current workplace pension provider, which is usually listed on your payslip or annual statement. Second, search online for that provider's total assets under management to see how close they are to the £25 billion target. Third, Check your annual pension statement for any mention of a merger, consolidation, or change of scheme administrator. Fourth, if you have several old pension pots from previous jobs, gather their details together in one simple document. Fifth, keep an eye on GeoGov UK and the Pensions Regulator website for official updates as these new rules are rolled out. None of these checks take more than a single afternoon, yet they could save you real confusion further down the line. Sixth, if you receive any letter mentioning a scheme merger, a new provider, or a change of trustee, read it carefully rather than filing it away. These letters can sometimes look like routine admin, when they actually mark the moment your pension moves to an entirely new home. Seventh, if you're unsure about any of this, a free appointment with PensionWise can help you understand your own specific situation. Let's quickly recap everything we've covered, so it's crystal clear before you go. The Pension Schemes Act became law in April 2026, affecting roughly £2 trillion of pension savings across the UK. By 2030, large workplace pension schemes must hold at least £25 billion, or face being merged into bigger providers. Smaller pension pots worth £1,000 or less could be automatically swept into a new consolidator scheme. A value for money framework will soon force every scheme to publicly prove it is performing well for its members. Defined benefit schemes may release up to £160 billion in surplus cash back to employers. And from 2028, the government gains new powers to influence where certain pension funds are invested. Together, these changes represent one of the biggest shifts in UK pensions law in a generation. Officials estimate the reforms could add up to £29,000 to the pension of an average working person over their career. That figure depends heavily on how well the new megafunds actually perform, which nobody can guarantee in advance. You may not notice any of this happening unless you take a few minutes to check your own pension details. Doing that small amount of homework now could protect you from surprises when these changes fully take effect. If this video helped you understand what's really happening with your pension, please consider subscribing for more updates like this one. I cover changes to the state pension, DWP rules, and HMRC tax updates every single week, so you never miss something important. Give this video a like if you found it useful, and share it with anyone who might have a pension they've never checked. Thank you for watching, and I'll see you in the next one, where we'll break down another change that could affect your money.